Three of the most successful investors alive spent this summer doing the exact same thing, selling assets and stacking cash. Ka-shing's group unloaded three British infrastructure businesses. Berkshire Hathaway piled up the largest corporate cash reserve in history, and Pansy Ho cleared out her entire stake in MGM Resorts in 5 trading days. Three separate stories, one identical move. Now here's the part almost everyone gets wrong. They are not betting on a crash, they are buying something else entirely. I'm Alex Alpha. Let's find out what. Start with the CK Hutchison Group. In the first half of this year, it closed out 3 British assets in a row. In January, Eversholt Rail, the UK rail leasing platform, for about £1.1 billion. In May, UK Power Networks, the electricity distribution business, for £10.5 billion. And in July, the remaining 49% of Vodafone 3 for roughly £4.3 billion. Rail, power, telecom, 3 of the most boring, most reliable cash machines in the developed world. Look at what that did to the balance sheet. Net debt fell 44%, from 113.8 billion Hong Kong dollars at the end of last year to 63.7 billion. Leverage, net debt to net total capital, dropped from 13.9% to 8.1%, a record low. Cash and liquid investments reached 187 billion Hong Kong dollars. Reported profit jumped over 30 times, but strip out the disposals and underlying earnings grew just 6.7%. So this was never about earning more. It was about changing form. Case 2, Berkshire Hathaway. By the end of the first quarter, its cash and treasury bills hit $397 billion, the largest liquid reserve any public company has ever held, bigger than Apple, Amazon, Alphabet, and Microsoft combined. That pile was built by 14 straight quarters of net equity selling. Apple, once nearly half the portfolio, was cut by roughly 75% from its peak. Bank of America trimmed repeatedly. The message was simple: at these prices, there is nothing worth buying. But here is where the popular story breaks, and this matters. In the second quarter, Berkshire flipped. It became a net buyer of nearly $20 billion in equities, bought back $4.5 billion of its own stock, and the cash pile actually fell to $365 billion. So the world's most famous cash hoarder just started spending, which tells you the 14-quarter retreat was never a crash forecast. It was a price problem, and when the price is right, the cash goes to work. Case 3. Pansy Ho. Between May 28 and June 3, 5 trading days, she sold 3.06 million shares of MGM Resorts International, taking her stake from 1.2% to exactly zero for about $140 million. Her timing was almost surgical. On June 1st, People Inc. offered $48.30 a share to take MGM private, valuing it above $18 billion. And what did she keep? Her 22.5% of MGM China, the Macau, China operation she actually runs, the one still growing earnings. Now line up all three, and the pattern is not sell everything. Ka-shing's group sold mature infrastructure with stable but capped growth. Berkshire sold what had run too far ahead of its own earnings. Pansy Ho sold the cross-border parent and kept the operating business she controls. In every case, the thing that got sold was the thing that only keeps working if the environment stays friendly. Low rates, strong growth, calm politics. That is not pessimism. That is removing conditions. And there is a very unglamorous reason this is easy to do right now. Cash finally pays. A 3-month US Treasury bill yields about 3.8%. So sitting still earns you real money on top of full liquidity and zero duration risk. For 20 years, the cost of waiting was the returns you gave up. Today, waiting has its own yield, and that quietly changes the entire calculation of patience. Now, for the part that looks like a contradiction. While these investors were stacking cash, gold went vertical. In August alone, spot gold rose almost 14%, breaking $4,500 an ounce on the 19th, with a single-day gain of 4.36%, then touching 4,660 on August 24th, a 3-month high. And remember, gold had actually fallen 7% in the first half of this year. So cash and gold are rallying together. On the surface, that makes no sense. Cash is a bet that assets get cheaper. Gold is a bet that cash gets cheaper. One wants deflation in asset prices, the other wants debasement of money. They should not work at the same time. Unless, and this is the whole point, they are not two trades at all. They are the same trade with two different failure modes. Both are saying today's prices are not sustainable. Cash protects you if the correction comes through asset prices. Gold protects you if the correction comes through the currency. You are not choosing a direction. You are choosing which kind of repricing you want to be insured against. Walk through scenario 1. Equities, property, and private valuations revert toward their averages. In that world, cash is not idle money. It is an option to buy with no expiry date and a positive carry while you wait. That is exactly the position Berkshire spent 14 quarters building and exactly the position it started exercising in the second quarter. Now, scenario 2, which is far more likely and far less discussed. Assets do not fall because the state will not let them. On August 19th, The US Treasury doubled its buyback ceiling for long-dated bonds from $2 billion to $4 billion per operation. Long yields dropped, the dollar weakened, and gold exploded on the same day. With federal debt past $40 trillion, that is the playbook: support the market, cap financing costs. But if assets are not allowed to reprice, then the thing that reprices instead is the money. And the biggest players are already positioned for that. Central banks bought a net 289 tons of gold in the second quarter alone, up 62% year over year. China's central bank has added gold for 21 consecutive months, nearly 20 tons in July alone. According to the European Central Bank, gold has now passed US Treasuries to become the single largest asset in global official reserves. The institutions that define what risk-free means are quietly redefining it. Which brings us to the real difference, and it isn't about being bearish. The titans are buying optionality: cash if assets fall, gold if money falls. Two insurance policies against two opposite outcomes. Most people cannot afford both, so they park their entire net worth in a single version of the future and hope. The wealthy hold counter-cyclical liquidity. Everyone else holds pro-cyclical comfort. That gap is not about forecasting skill, it's about who can afford to be wrong. So no, the titans are not calling a crash, they are lowering the number of things that have to go right. That is a discipline you can copy at any size, with any portfolio. I'm Alex Alpha. If this changed how you read the word retreat, subscribe, and I'll see you in the next one.